Welcome back to the Deep Dive. This is where we take a stack of sometimes conflicting source material articles, research papers, financial reports, and we really try to extract the most important nuggets of knowledge or insight, giving you the shortcut to being truly well-informed. Today, we are deep diving into PayPal Holdings, Inc., ticker PYPL, and the puzzle facing the market here is, it's a classic one.
It truly is. It's a study in contrast. When you look at our source material for today, you're looking at two radically divergent realities. Right. On one side, we have this deeply optimistic quantitative data. It shows a rigorous financial turnarounds being led by new management. They're hitting these critical new profitability metrics.
And a huge capital return program.
The most aggressive in the company's history, yeah. It's a very compelling story if you just look at the numbers.
And then on the other side, we have this qualitative analysis. It's almost a scathing dossier detailing a massive, and I think you have to say, self-inflicted user trust crisis.
Self-inflicted is the key phrase there.
Yeah. And it's talking about high fees that are actively alienating merchants and consumers, and some really serious existential competitive threats that suggest PayPal's famous moat might be rapidly drying up.
Exactly. So the core tension we are tasked with unpacking today for you, the listener, is this. How can PayPal's financial health appear to be improving so dramatically, with its stock still priced as if it will never grow again, while at the same time it's facing this documented customer exodus? Is this a deeply undervalued compounder, or is this new financial discipline just, masking a deep structural erosion of the underlying business?
That's the mission.
That's the mission.
And to really understand the weight of this dilemma, you have to look at the market context. This company went through a period of just severe valuation compression.
Oh, absolutely.
During the pandemic e-commerce boom, the stock's price to earnings multiple, the PE, it ballooned to over 50 times earnings. That reflected these massive, hyper-growth expectations.
Right. The market was pricing imperfection.
And that multiple has since contracted severely, landing in what you'd have to call value territory at roughly 12 times today.
And that compression, that 50 down to 12, that reflects deep skepticism. PayPal is at a defining inflection point in its post-eBay corporate life cycle. The old playbook, the one that drove that 50x multiple, was all about chasing growth at all costs. It was measured by these vanity metrics like total active accounts, total payment volume, or TPV.
Right.
Often completely irrespective of the quality or the profitability of that volume.
So just get the number up.
Get the number up, whatever it takes.
And the new strategy, it's a complete overhaul. It's being championed by the new CEO, Alex Chris. It's a disciplined focus on what management calls profitable growth.
And crucially, transaction margin dollar expansion. We need to find out today if this strategic pivot is a foundation for a new, stable phase of growth, or if it's just, rearranging the deck chairs while the ship of user goodwill is sinking.
Okay, let's start where management wants the market to focus then. Let's start with the numbers. Because the latest financial scorecard, specifically Q3 2025, is genuinely impressive. It shows clear execution of this new discipline strategy.
That's the consensus takeaway from the financial source material for sure. For the third quarter of 2025, PayPal reported net revenues of $8.42 billion.
And that was a healthy increase, right?
It was a very healthy 7.3% increase year over year, or 6% if you strip out the currency fluctuations. But importantly, this comfortably exceeded the Zacks consensus estimate of $8.26 billion.
So it's a beat.
It's a beat, and that's a signal that the top line is stabilizing and beating what the street expected.
But here's where it gets really interesting, though, because management explicitly told analysts to stop focusing just on revenue and TPV. They introduced a North Star metric to guide the market's attention toward quality.
Yes, and understanding this metric is paramount for analyzing the new PayPal. The North Star metric is transaction margin dollars, or TMO.
Okay, break that down for us. What is that exactly?
So it strips away all the noise. It takes out the low-quality, high-volume, low-margin transactions, and it focuses only on the gross profit derived from their core transaction services.
So it's a measure of the health of the core business.
Precisely. Transaction revenues still make up nearly 90% of the top line, but if you're just growing your total payment volume by accepting really low-margin, high-cost payments, your core business is actually deteriorating. TM1 is designed to directly measure the quality and health of that core payment engine.
So how did they perform on this new metric that they themselves defined as the most important one?
Impressively. In Q3 2025, TM1 grew by 6%, reaching $3.87 billion. But But we need to zoom in on the nuance here because the source material highlighted this specifically to counter the bearish thesis.
Which was what? What were the bears saying?
The bears were saying that, PayPal has this revenue stream from interest it earns on customer balances held in their system.
Right, with interest rates being high.
Exactly. Since interest rates have been high globally, skeptics argue that PayPal's recent financial stability was just an artifact of that high interest rate environment. They were saying it was masking a deeper deterioration in the core payment volume business.
Okay, so a fair point. So did they address that? Did they pull that thread to isolate the core payment health?
They did, explicitly. Management stated that when they exclude that highly interest rate sensitive stream of revenue, the transaction margin dollars still grew by 7%.
Wow, so it actually grew faster without the interest income.
Faster. This is a really compelling rebuttal to the bears. It establishes that the underlying payment mechanisms, the actual processing of payments between consumers and merchants, is becoming more efficient and more profitable, totally independent of the macro rate environment.
So that's a foundational achievement for this whole profitable growth narrative they're pushing.
It absolutely is.
Okay, so let's unpack this theme of operational efficiency further. The new leadership, specifically Alex Chriss, seems to be focused on this operational streamlining, which some people are calling the Intuit playbook. Just squeezing more profit out of the existing revenue base.
That streamlining is evident right across the income statement. The profitability metrics showed significant operating leverage.
Meaning costs grew slower than revenue.
Exactly. So your non-GAAP earnings per share, or EPS, it reached $1.34. That easily surpassed the street consensus of $1.19. That's a 12% year-over-year increase in EPS.
And the margins.
Crucially, the GAAP operating margin expanded by 33 basis points, landing at 18.1%. They are clearly demonstrating an ability to convert that revenue growth into even faster profit growth through really aggressive cost control.
There was one small metric in the report, and it might seem technical to the listener, but it's absolutely central to profitability, and that's the transaction expense rate. It tracks the cost of processing those payments, things like interchange fees paid to the card networks. And we saw it improve slightly, dropping from 0.91% of TPV down to 0.89%.
And this is where we have to slow down and truly quantify what that means. That seemingly tiny 2 basis point drop from 0.91% to 0.89% is highly significant when you realize they processed $458.1 billion in TPV during the quarter.
Okay, yeah, let's quantify that for the listener. What is the real-world impact of that 0.02% saving on that massive volume?
Well, a small fraction of a percent across hundreds of billions of dollars adds up very, very quickly. This improvement suggests successful management of what they call the funding mix.
Meaning how people pay?
Exactly. PayPal's highest cost comes from transactions funded by high-cost credit cards. By successfully encouraging users to link their bank accounts for transfers or to use their stored PayPal balance, both of which are lower-cost funding sources for PayPal, that tiny 2 basis point difference drops directly to the bottom line.
And strengthens the transaction margin dollars we were just talking about.
It all connects. It demonstrates successful, granular execution on a scale that, frankly, few other companies can even match.
So this focus on quality over quantity, it's perfectly crystallized in what the source material calls the account shuffle. Total active accounts grew modestly to 438 million, and TPV grew a solid 8%. But payment transactions per active account, or TPA, it decreased by 6% on a trailing 12-month basis.
Right.
Now, if I'm looking at the surface, that decline in activity per user looks like a major red flag.
It looks bad, I agree. But this is the perfect moment to apply some critical analysis. The headline TPA decline is actually a direct and deliberate result of the new strategy.
How so?
Management is executing a strategic churning of low-value, inactive accounts. They finally realized that maintaining millions of dormant accounts, the ones people sign up for to get a single coupon or for a temporary use, is a vanity metric.
It just looks good on a slide.
It looks good, but it consumes marketing dollars, it consumes infrastructure resources, and potentially regulatory compliance costs, all without yielding any meaningful revenue.
Okay, but wait. Isn't that just a fancy way of saying they're deleting the accounts that might eventually grow into high-value users? I mean, aren't they potentially stunting future growth just to polish the current quarter's metrics? That sounds like classic short-termism, sacrificing the top of the funnel for immediate efficiency gains.
That's a very fair challenge, and it's the exact risk that management is trying to navigate. Their argument is that By focusing their resources and their marketing spend only on the high-value, engaged accounts, they maximize the return on their capital, and they have data to back up their claim that this isn't sacrificing the core business.
Okay, so what data supports the claim that the core is actually healthy?
This is the vital insight that's buried deep in the reports. When you exclude what are called payment service provider, or PSP, transactions.
Okay, what are those?
That's the high-volume, low-margin, unbranded processing that we'll discuss later. It's the Braintree stuff. When you take that out, the TPA, the transactions per active account, actually increased by 5%. This shift indicates that the core loyal user base, the ones who are hitting that premium branded checkout button, they're transacting more frequently than before. The decline is purely in the dormant, low-value periphery.
So that is the definition of a successful pivot to profitable growth.
It's exactly that. Lower quantity, higher quality, and deeper, more valuable engagement from the users who actually matter most to the bottom line.
So efficiency is up, margins are up, and core engagement is up. But the central pillar of the investment thesis going forward isn't just efficiency, it's how they are using the cash generated from that efficiency. And that's this massive stock repurchase program.
Capital allocation is the game changer here. PayPal is an enormous free cash flow machine. It generates billions annually, and management recognizes that the stock trades at what they see as an undeniable discount.
What were the numbers for the quarter?
In Q3 2025 alone, they repurchased 21 million shares for $1.5 billion. Over the trailing 12 months, they returned $5.4 billion to shareholders just through these buybacks.
And the future commitment to this strategy is just immense.
It's incredibly powerful. Earlier in 2025, the board authorized a brand new $15 billion stock repurchase program.
Let's put that in context for you. Based on the stock's current market capitalization of around $60 billion, that authorization represents the ability to remove nearly 25%, 1/4, of the company's total outstanding float from the market.
It's a staggering amount.
For listeners trying to wrap their heads around that level of commitment, what specific risks are they ignoring by being this aggressive? And, what does it do structurally for the stock?
Well, first and foremost, they are signaling, in the strongest possible terms, that they believe the stock is profoundly undervalued. They view their own stock as the single best investment available to them.
Better than R&D, better than acquisition.
Better than anything else they could do with that cash. And structurally, this creates a massive, powerful floor for earnings per share. Even if net income growth is modest, reducing the share count by 1/4 guarantees a significant structural tailwind to EPS growth. It could push it into the mid-teens, which is precisely the guidance management is providing.
So it's an engineered growth story, in a way.
It's an aggressive, disciplined strategy designed to reward existing shareholders by concentrating ownership in a growing stream of cash flow. It's pure value creation.
Okay, so now that we've established the financial pivot, this shift to TM1 and aggressive buybacks, let's deconstruct the PayPal business model itself and define its competitive advantages as seen through that financial lens. PayPal is, at its core, a global two-sided network connecting hundreds of millions of merchants and consumers.
And that network generates revenue that, as you mentioned, is nearly 90% transaction-based, but not all transactions are created equal. You essentially have two distinct businesses operating under the PayPal umbrella.
Okay, which are?
First, you have the high-margin, premium-priced, branded checkout. This is the classic yellow PayPal button you click at checkout.
The one everyone knows.
Right. And merchants tolerate the higher fees that come with it because it results in significantly higher conversion rates, sometimes 10% to 20% higher than traditional credit card processing.
Why is that?
Because consumers trust it. They don't have to get up, find their wallet, and type in a 16-digit card number into some website they've never heard of. They just log in.
And the second business is the low-margin volume game, which is crucial for massive enterprise clients.
That's Braintree. That's their unbranded processing platform. Braintree powers the back-end payments for huge high-volume enterprises like Uber and Airbnb.
So it's invisible to the user?
Completely invisible. And this is a very different commoditized business. Braintree competes almost purely on price, efficiency, and reliability with rivals like Adyen and Stripe. And if Braintree volume continues to grow faster than the branded volume, which is often the case given the enterprise nature of it, it naturally compresses PayPal's overall corporate take rate and margin over time. That's a structural risk to be aware of.
Beyond just transactions, we saw the value-added services, or VAS, segment acting as a high-margin growth vector.
VAS is absolutely essential for diversification and for margin expansion. This includes things like subscription fees, gateway fees, referral fees, and importantly, the interest earned on customer balances, which we discussed earlier.
And how's that segment doing?
In Q3 2025, VAS revenue grew robustly by 14.7% to nearly $900 million. This shows PayPal is effectively monetizing the entire customer lifecycle, not just that single payment event itself.
We have to revisit the credit model here because the pivot to an asset-light model is directly funding the balance sheet strength we were just talking about.
Yes, the asset-light transition is a critical de-risking move. Historically, PayPal held all the consumer receivables for products like PayPal Credit and Pay in 4 right on their own balance sheet.
Meaning they took all the risk if someone defaulted.
They absorbed all the default risk, and it required significant regulatory capital reserves to be set aside.
And what does asset-light mean in practice? How do they change that?
It means they are selling or offloading those receivables and the associated balance sheet risk to specialized external lenders. They've done this primarily through partnerships with massive financial players like KKR and Blue Owl.
So PayPal still originates the loan.
Yes, PayPal still services the credit products. They get a fee for originating the loan and managing the relationship, but they eliminate the massive capital and regulatory burden of carrying the risk. This transition is directly responsible for freeing up billions of dollars in capital,
which they are now directing toward that $15 billion stock repurchase program.
Exactly. It connects Section 2's de-risking directly to Section 1's capital return strategy. It's all part of the same plan.
Okay, let's turn to the competitive moat. Historically, PayPal's dominance was built on two primary pillars: trust and data.
Trust is foundational. Think about the early days of e-commerce, or even today when you're shopping at a small, unfamiliar online store. Consumers are intensely wary of entering their card details because of cyber fraud risk. PayPal acts as that trusted intermediary. You click the button, you log in, and your sensitive payment information remains safely stored behind PayPal's digital firewall. That psychological benefit provides peace of mind, which translates directly into higher merchant conversion rates.
And the data advantage, the closed-loop system, that's truly unique to them in the payment world.
Precisely. Most payment processors are either on the consumer side, like issuing banks, or on the merchant side, the acquiring processors. PayPal, however, sits right in the middle. They see the entire transaction flow from end to end.
So they see both sides.
They see the consumer's funding source, the issuing side, and the merchant receiving the money, the acquiring side. This unique closed-loop dataset allows for superior fraud detection capabilities.
How does that superior visibility translate into a tangible competitive advantage for a merchant?
Higher authorization rates. Because they can better predict fraudulent transactions, they mistakenly flag fewer good transactions as fraud, a false positive.
Right, so a legitimate customer doesn't get their card declined for no reason.
Exactly. A higher authorization rate means more sales for the merchant and a smoother, less frustrating experience for the consumer. Competitors operating in an open-loop system simply don't have this comprehensive view of the entire transaction.
And this data advantage is the key pillar for Alex Chris's next major growth vector, the advertising business.
It is the foundation of their future strategy. The plan is to leverage that massive treasure trove of closed-loop purchase history data to serve personalized, highly targeted offers to consumers within the PayPal and Venmo ecosystems.
So they know what you buy and can target ads based on that.
Better than almost anyone. This allows them to effectively enter the high-margin advertising business based on actual commerce intelligence, creating a brand new, highly profitable revenue stream that current valuation metrics are not fully factoring in. That's the potential value that investors are betting on.
To give listeners the full context of PayPal's financial evolution, we should probably review the historical metrics. The story is clearly one of a transition. It moved from a high-growth spinoff. We saw revenue growth of over 20% during the peak e-commerce acceleration of 2020, to a much more mature, stabilized, mid-single-digit grower. The trailing 12 months, or TTM, revenue growth for Q3 2025 is now just 4.5%.
And this transition means that the growth investors, they left the building, and now the value investors are circling. The focus has shifted entirely to profitability and returns on capital, which is where PayPal truly shines as a business.
So what are those numbers?
We see consistently high returns. The return on equity, or ROE, sits at an impressive 24.3%. And the return on invested capital, ROIC, is 14.6%.
What does that mean for the listener who might not track these metrics daily? Why is that important?
It means that every dollar of profit that PayPal retains and reinvests back into its business generates a 14.6% return. Both ROE and ROIC significantly exceed the company's cost of capital, which is a crucial measure of quality.
So they're creating value with the money they keep.
They are. It proves that PayPal is an economically high-quality business, generating substantial value for shareholders with every dollar they choose to reinvest rather than return. They're compounding capital effectively, even if that top-line revenue growth has slowed down.
And finally, the balance sheet underpins all of this. It's categorized as a fortress balance sheet.
Indisputable. The company is in a net cash position, meaning their cash and equivalents significantly exceed their total debt. They hold $14.4 billion in liquidity, and they maintain robust interest coverage. Their earnings before interest and tax, their EBIT, covers their interest expense more than 13 times over.
Which gives them a lot of flexibility.
It's a financial impregnability that is the ultimate enabler for that massive buyback program, and it provides a substantial margin of safety against any competitive execution risks.
So if we look purely at the financial reports and the management execution plan, we see a profitable, mature compounder, shedding low-value users, aggressively buying back stock, and run by a team laser-focused on quality metrics. It paints a very optimistic picture.
And now, we must turn the canvas over and examine the dark, qualitative reality that analysts fear is silently undermining that financial strength, the customer experience. This is where we shift sharply and introduce the massive tension in the source material, the erosion of user trust.
We move from the quantitative metrics of Section 1 and 2 to the qualitative reality of the user base. And the second set of sources introduces this corrosive concept of the ubiquity tax. This is what happens when a company becomes so dominant, so fused into the fabric of global e-commerce that it stops competing on value or speed or service and instead starts charging based simply on its market presence. Because, where else are you going to go?
PayPal has certainly pushed its customers, both consumers and, crucially, small merchants, to the absolute limit regarding fees. For merchants, the base costs are already high. The core online rate is 3.49% plus 49 cents for a standard U.S. transaction.
Which is already high.
That's already significantly higher than many newer processors that are out there.
But the costs don't stop there, do they? Especially not for global sellers.
They absolutely don't. International payments add an additional 1.5% markup just for the cross-border movement of money. Then, if the payment involves a currency conversion, there are these hidden currency conversion fees, which often skim another 3 to 4% off the top.
So a single international transaction can get hit 3 times.
3 separate layered charges, making PayPal one of the highest cost providers for cross-border e-commerce, which is exactly where new competitors are innovating aggressively.
And the consumer is paying this tax too, even just to access their own money.
That's the invisible toll, yeah. If you have funds sitting in your PayPal account and you need instant access, which is a requirement for many gig economy workers or small sellers who need that cash flow.
Right, they can't wait 3 days.
They can't. So PayPal charges you an immediate 1.75% right off the top to transfer to your bank. If you cash out frequently, that is a steady, almost invisible tax on your own liquidity, simply to move your money from their ecosystem into your own bank account a little bit faster.
And when things inevitably go wrong, the fees become punitive for merchants. This fuels, from what I've read, massive frustration.
The dispute process is a massive pain point. When a transaction is disputed, whether it's a fraudulent charge or a customer demanding a refund, PayPal slaps the merchant with a dispute fee. In the U.S., they often cite a $20 chargeback fee, regardless of who wins the dispute.
Wait, even if the merchant is proven right?
Even if they win. So merchants feel penalized simply for participating in e-commerce. They have to pay a fee even when they successfully prove they delivered the item and the transaction was legitimate. This contributes heavily to the perception that the platform prioritizes its own financial protection over any sense of fairness to its business users.
It seems as the fees rose, the popular customer perks just vanished. We saw the cut of the popular Return Shipping on Us program in late 2022.
That was a huge one. That program was a massive psychological benefit for consumers. It was that peace of mind that if an item didn't fit or wasn't what you expected, shipping it back wouldn't cost you anything.
And cutting it was a clear signal.
A very clear signal that the company was prioritizing cost reduction over the user experience. And compounding that globally, they introduced inactivity fees, up to 10 for dormant, non-U.S. accounts after just 1 year of sitting idle.
So if you don't use it, you lose it.
Exactly. Again, this is a clear move to optimize for those transaction margin dollars by getting rid of those low-value accounts. But it absolutely creates ill will. It fosters the feeling that PayPal is actively looking for ways to extract money from every corner of its user base.
That aggressive fee structure and the disappearance of perks, I mean, that might be tolerable if the customer service acted as a reliable safety net, but the qualitative reports suggest the reality is closer to a complete collapse.
Customer service is arguably the single biggest failure point that's fueling this user exodus. PayPal's rating on the Better Business Bureau it's a devastating 1.1 out of 5 stars.
1.1.
And this score is tied directly to the loss of that historical moat of trust we identified earlier. When things go wrong, the consumer or the merchant enters a black box of automated responses and unhelpful support.
And the most common complaint in the source material is the sheer tyranny of arbitrary account freezes.
This is so serious because it involves access to people's livelihood. The automated risk systems are designed to protect against fraud, but they often lock accounts for what seem like completely benign reasons: a large transfer, logging in from a new country, or sometimes just a system glitch.
And there's no recourse.
Often with no clear human recourse. Users report being locked out of their own funds for months, and in some documented cases, even for years. For a small business, having your entire operating cash flow frozen by an uncommunicative system it's an existential threat.
The ultimate paradox here is that this overly aggressive security system is supposed to protect users, yet the source material describes PayPal, particularly for buyers, as rapidly becoming a scammer's paradise.
It speaks to a fundamental flaw in their purchase protection system, especially for inexpensive goods. Take the infamous empty box scam. A fraudulent seller ships a box containing nothing but provides a valid tracking number. Because PayPal only requires proof of delivery, they will often side with the scammer, especially for goods under $750, which don't require a signature.
So it's impossible for the buyer to prove they didn't get it?
It becomes almost impossible for the consumer to prove they didn't receive their item if the system only cares about that delivery confirmation from the tracking number. The system isn't designed for that kind of nuance.
And there are other tactics that entirely bypass protection, often exploiting user trust. The friends and family method is frequently cited.
Where the funds transfer bypasses protection entirely because it's marked as a gift.
Or the increasingly sophisticated phishing scams using convincing, official-looking PayPal invoices that contain alarming text like, incoming $500 charge, call this support number now.
Which then leads the panicked user to a fake support line, where they hand over their login details or personal information. It creates this sense of systemic distrust. Users feel the platform is expensive, it's punitive to sellers, and paradoxically, it's increasingly unreliable for protection, despite its historical reputation being built on that very promise.
But the issue of control goes even deeper for sellers, entering the realm of what the sources call fund-hold tyranny.
This is highly punitive to small businesses. PayPal's own terms allow them to hold funds for up to 21 days for security purposes, especially for new sellers. But beyond that, they can impose an arbitrary safety buffer or a reserve limit, often holding 10% to 30% of a business's operating cash flow.
And for how long?
Crucially, this reserve is only reviewed on a 180-day cycle, meaning they can hold significant portions of a business's income for months on end if they deem the business high risk for whatever reason they decide.
The anecdote from the UK charity case is highly illustrative of this disproportionate power.
It's striking. A UK charity that relied on PayPal for its donations had 90% of its income held by PayPal from February all the way to July.
90%.
They correctly argued this was crippling their entire operation. A court eventually had to step in, ruling the reserve limit incredibly disproportionate, and ordered PayPal to pay 8% interest and compensation for the funds they held.
But for any small business, a 90-day hold on operating cash flow can be the difference between paying your suppliers, making payroll, and going out of business entirely.
Well, absolutely.
So if the arbitrary fund holds confirmed PayPal was a strict financial gatekeeper, the infamous misinformation fiasco of October 2022 confirmed user fears that PayPal saw itself as an authoritarian gatekeeper attempting to police speech.
That was a watershed moment of corporate self-sabotage. PayPal briefly published a policy update suggesting users could face financial damages up to $2,500 for vaguely defined prohibited activities, including the sending, posting, or publication of any messages, content, or materials promoting misinformation.
The backlash was immediate and just, intense. It threatened a massive user revolt.
It broke trust on a fundamental level. Even PayPal's own former president, David Marcus, publicly slammed the move. He said it goes against everything I believe in.
And they walked it back, but...
They quickly walked it back, yeah. They claimed it was an error, that it was published prematurely, but the damage was irreversible. Users saw PayPal not just as a financial processor, but as a moral arbiter with the power to reach into their accounts and extract money based on subjective, undefined rules about speech.
And the data supports the notion that this was the final straw for many users who were already frustrated by that ubiquity tax.
It was the defining qualitative event. Following that misinformation disaster, PayPal's total active user counts peaked, and then, for the first time in their entire history, began to decline.
Wow.
This shows a fundamental, widespread shift in user sentiment. The combination of high fees, terrible service, and the loss of neutrality drove users to actively seek out alternatives.
This leads us directly to the existential competitive threats, because the old moat of convenience and ubiquity is being directly challenged by two major forces that move faster and cheaper: cross-border payments and the hardware that's already in your pocket.
Cross-border payments used to be PayPal's lucrative high-margin playground, fueled by those layered currency markups we talked about. Now, companies like Wise and Payoneer have completely redefined the game.
How so?
Their entire value proposition centers on transparency, low upfront fees, and the use of the real mid-market exchange rate, not some marked-up proprietary rate that PayPal uses.
And the speed is what kills the competition.
Exactly. Wise, for example, reports that about 65% of their transfers land in the recipient's bank account in 20 seconds or less. PayPal is comparatively slower and far, far more expensive. The new benchmark for global payments is now speed and transparency, areas where PayPal is structurally disadvantaged because of its legacy fee structure.
But the biggest, most visceral threat has to be the device wallet: Apple Pay and Google Pay.
This is the ultimate convenience killer for PayPal's high-margin branded checkout button. Device wallets are preloaded onto your phone, they require zero login, and they sit right in the thumb zone of the screen when you are checking out on a mobile device.
And we know most shopping happens on mobile now.
We know that 70% of e-commerce purchases during the last major holiday season were made on a smartphone.
So when a customer is ready to buy, the quickest one-tap solution always wins. And PayPal, in comparison, now feels clunky.
It is fundamentally slower. Clicking the PayPal button often requires waiting for a new window to open, maybe logging in again and navigating multiple steps. It is now undeniably slower and less convenient than the default wallet that's already built into your phone.
And merchants recognize this. They see that friction costs them conversion.
And this leads to merchant steering. Shopify, for example, is actively pushing its massive user base toward its own integrated solution, Shop Pay.
Because it's better for their merchants.
Right. Merchants prioritize the payment button that converts buyers best. If a one-tap solution like Apple Pay or Shop Pay significantly reduces cart abandonment, they will list those alternatives above PayPal, pushing that higher-margin PayPal button down the page and reducing its visibility and its usage. The loss of convenience is a direct threat to the core branded checkout volume that management is counting on for that profitable growth.
So we stand at the nexus of these two realities. On one side, we have a financial powerhouse shedding low-value bulk, growing margins, and returning vast sums of capital to shareholders. On the other, we have a company with a collapsing trust profile, punitive fees, and an inferior, slower product experience compared to its modern competitors. Now we have to reconcile these perspectives and apply a rigorous financial analysis to the stock price.
We must assess the intrinsic value by integrating the risks we just outlined in Section 3. The ubiquity tax, the customer service collapse, the competitive threats. We have to bake that into the valuation model. And if we apply the classic Buffett-style quality filters, the financials, they pass with flying colors.
Okay, let's run the quality check for the listener. First up, cash generation.
Strong pass. PayPal is inherently a capital-light business. It doesn't require heavy ongoing infrastructure or CapEx to sustain its operations. This means it converts a very high percentage of its net income into free cash flow, or FCF. In 2024, it generated $6.8 billion in FCF on $31.8 billion in revenue. That's an FCF conversion ratio of over 21%. The cash generation is substantial and it's reliable.
Okay, second, the profitability check.
Another strong pass. We already established a high return on equity, ROE, of 24.3%, and the return on invested capital, ROIC, of 14.6%. These metrics prove the company is highly efficient at turning retained capital into shareholder value. It's financially a very high-quality business.
So the divergence comes entirely down to the valuation, where the market is clearly pricing in all of the qualitative risks we just spent the last section discussing.
That's the classic market misalignment. The current valuation, a price-to-earnings, or PE, ratio of roughly 12.3x, and a price-to-free cash flow ratio of about 10x, that is pricing the company for near-zero growth forever.
But that's not what management is guiding to.
Not at all. Management is guiding for 15% to 16% non-GAAP EPS growth for the full year 2025, largely thanks to those buybacks.
It's this huge gap between the quality metrics and the market price that just screams value trap to some people and deep value to others.
Exactly.
Yeah.
And, it's funny, this is the kind of situation that tools that track market temperature are kind of built for.
Right, like trying to get a read on whether the whole market is frothy or if this is just an isolated case of pessimism about one company.
Precisely. And for you, the listener, if you're interested in tracking those broader market signals against these kinds of deep value quality screens, you might want to check out an app called the Buffett Indicator.
Oh, right. It's on the Apple App Store, I think.
It is, yeah. It's a really neat way to just, keep an eye on that bigger picture, that overall market sentiment we're talking about, and get a daily read on that temperature.
Good to know. So when we look at the specific valuation for PayPal, we can use something like the PEG ratio.
Indeed. When we look at the PEG ratio, which is price earnings divided by growth for PayPal, it sits well below 1.0. It's somewhere between 0.65 and 0.84.
Which technically suggests deep undervaluation.
Deep undervaluation, yeah. Even when you account for all the concerns about moat erosion and execution risk. The market is offering a substantial discount because of the uncertainty that's associated with that product experience.
To quantify this uncertainty, we need to move to the discounted cash flow, or DCF, scenarios. This forces us to assign probabilities to management's ability to overcome these competitive threats.
Right. The DCF analysis requires some critical assumptions. We're going to use a relatively high 10.0% discount rate, or WACC, to explicitly factor in those very real execution and competitive risks.
So a higher hurdle rate.
A much higher hurdle rate than you'd use for a pure utility company. And we'll assume a stable 3.0% terminal growth rate, which is aligned with long-term global GDP and inflation.
Okay, so let's start with the most pessimistic outlook possible. Scenario 1, the stagnation case.
In this scenario, we assume the worst of the qualitative analysis comes true. PayPal loses branded market share rapidly to Apple Pay, the Braintree margins compress further due to competition with Stripe and Adyen, and the new advertising strategy completely fails to gain any traction. FCF only grows by a meager 2% annually, barely keeping pace with inflation.
If that worst-case stagnation scenario plays out, what's the implied share price from the DCF?
In the stagnation case, the intrinsic value is approximately $52 per share. Given the stock is currently trading slightly above $61, this suggests a minimal margin of safety if the strategy completely fails, but it does establish a structural floor.
Why is the floor not zero? Why is it still $52?
So because of that high cash generation we just discussed, even if growth stalls completely, the company's still a capital-light enterprise generating $6.8 billion in free cash flow every single year. That massive, reliable cash flow stream provides intrinsic value that you just can't ignore. The $52 floor reflects the value of that stable, zero-growth cash stream.
Okay, now for scenario 2, the nominal or base case. This assumes Chris and Miller execute reasonably well, and they hit their strategic targets.
Here we assume the strategic pivot works. Revenue grows a modest 6-7% annually, margins stabilize thanks to that cost discipline, and the aggressive buybacks reduce the share count, successfully concentrating the FCF per share. In this case, FCF grows 8% annually, and that's primarily driven by efficiency and the reduced share count.
If they achieve this nominal execution, which seems reasonable given the current data, what's the intrinsic value?
The implied share price rises to approximately $80. That represents a potential 30% upside from the current trading levels. This scenario really hinges on the profitable growth outpacing the loss of user convenience and trust that's caused by the ubiquity tax.
And finally, the optimistic scenario. What if the moat doesn't just hold, but it actually widens?
In scenario 3, the optimistic case, we assume the PayPal Everywhere strategy succeeds, Venmo fully monetizes its massive user base of younger consumers, and the planned advertising revenue scales significantly because of their powerful closed-loop data advantage. In this world, FCF accelerates to 12% annual growth.
That sounds like a return to the market optimism of the pre-crash era. What does the DCF say?
The DCF analysis suggests an implied share price of $100 or more. That would be a 63% upside from current levels. The gap between the $52 stagnation case and the $100 plus optimistic case really demonstrates that the stock's current price is heavily discounted due to sentiment and execution risk.
So who is buying this uncertainty and who is selling?
Our final synthesis points out the divergence in sentiment, even among sophisticated market players. The source material notes some selling activity from insiders, like CEO Alex Chris, though that's often framed as being part of automatic 10b5-1 plans that are pre-scheduled.
But there's not a lot of buying.
The key caution flag here is the general lack of open market buying by these same insiders. They're not putting their own cash on the line at these prices.
But institutional deep value funds are clearly accumulating.
Yes. EdgeStream Partners, which is a recognized deep value fund, they increased their position by 350% in Q2 2025. Despite the poor press and the sentiment risk, the cold, hard numbers, the high ROIC, the low PE, the massive FCF generation, and that structural tailwind from the buybacks are attracting smart money.
So they're looking past the noise.
These funds see the value proposition at these discounted levels. The current disconnect is a classic market misalignment between financial reality, which is high profitability, and sentiment risk, which is driven by customer perception.
So we've concluded our deep dive into PayPal. We move from the impressive quantitative story of the Q3 2025 financial turnaround, highlighting that transaction margin dollar growth, the disciplined cost management, and the massive $15 billion buyback program designed to engineer EPS growth.
And we then sharply contrasted that with the self-inflicted wounds that are driving all the skepticism. The erosion of trust caused by the ubiquity tax, the high fees, the punitive fund holds, a failing customer service experience, and the fundamental challenge from hyper-convenient competitors like Apple Pay and Wise.
The company is undeniably transforming. It's moving from the speculative, hyper-growth stock of 2020 into a mature, disciplined, cash-generating compounder. They are sacrificing low-value volume for high-quality margin.
The central question for you, the investor, is whether this new focus on profitable growth is fast enough and sustainable enough to offset the structural erosion of trust and convenience that is driving the consumer to faster, cheaper alternatives. Can they stabilize the business while the product experience itself continues to deteriorate due to high fees and clunky checkout processes?
Here is a final provocative thought for you, the listener, to mull over long after this deep dive concludes. PayPal's financial strength is undeniable. They generate billions in free cash flow and deliver a very high 24% ROE. But the core moat of any payment network is psychological. It is trust. If the new profitable strategy alienates the loyal customer base to extract higher margins through fund holds, higher fees, and eliminating perks, what is the true long-term cost of the ubiquity tax? Can high profitability rates be sustained if the users eventually vote with their feet and fully commit to the one-tap convenience offered by Apple Pay?
That is the ultimate trade-off that the new management has to navigate. The tension between operational efficiency and long-term customer loyalty. And the market's discount suggests it remains highly skeptical of their ability to manage that trade-off effectively.
We want to remind you that all analysis presented in this deep dive is based on publicly available sources and is intended for educational purposes only. It is not investment advice. Please conduct your own thorough due diligence before making any financial decisions.
Additionally, if you want to listen to our full deep dive about this topic or access more advanced content that builds on these detailed analyses, we welcome you to join our Deep Value Club membership. You can also subscribe to us on Apple or Spotify podcast channel, Deep Value Investing.
Thanks for diving deep with us. We'll see you next time.